The banking system most people interact with on a daily basis is a carefully constructed interface designed for high-volume, low-risk transactions. For the vast majority of the population, the bank is a utility, a place to store a paycheck, pay bills, and perhaps secure a mortgage or a car loan. However, there exists a series of invisible thresholds where the fundamental rules of money, debt, and institutional behavior undergo a radical transformation. At these specific points, the relationship between the individual and the financial institution stops being a transactional service and begins to resemble a strategic partnership. To understand how this works, one must first look at how banks categorize their clients. In the retail banking sector, the individual is often viewed as a product. The bank accepts their deposits, pays a negligible interest rate, and then lends that same capital out at a much higher rate. In this ecosystem, the primary revenue streams for the institution are interest spreads and service fees. The bank's goal is to minimize the cost of servicing the account while maximizing the amount of capital it can deploy elsewhere. This is why retail customers often experience long wait times, automated customer service, and rigid lending criteria. The system is built for the masses, and the masses are governed by standardized algorithms. The first significant threshold typically appears when an individual's liquid assets reach the mid-six-figure range. This is the point where a bank shifts the client from the retail pool into premier or preferred banking. On the surface, this looks like better customer service, shorter lines, dedicated phone numbers, and waived fees. But behind the scenes, the bank's internal risk assessment is changing. The individual is no longer just a source of deposit capital. They are becoming a potential source of investment revenue and high-margin debt. What tends to happen at this stage is a shift in how credit is extended. For a retail customer, a loan is usually tied to a specific purchase, a house or a car. The asset being purchased serves as the collateral. But as the individual moves up the wealth ladder, the bank begins to look at the totality of their balance sheet. The pattern that emerges is the transition from income-based lending to asset-based lending. This is where the rules of the game start to diverge from the common experience. This channel explores the hidden mechanics of global finance and the structures that define the modern economy. To stay informed on how these systems operate and to understand the data behind the wealth, subscribing to this channel provides a consistent look into the institutional behaviors that are rarely discussed in the public sphere. As an individual crosses the $1 million threshold in liquid assets, they often enter the realm of private banking. This is a critical transition point. In the retail world, debt is often viewed as a burden, something to be paid off as quickly as possible to avoid interest. However, at the private banking level, the data suggests that debt is viewed as a surgical tool for liquidity and tax efficiency. One of the most common mechanisms used at this level is the Lombard loan or a securities-based line of credit. Instead of selling stocks or bonds to raise cash, which would trigger a capital gains tax event, the individual uses their investment portfolio as collateral for a low-interest loan. The bank is happy to provide this because the collateral is liquid and held within their own vaults. The individual benefits because they maintain their market position while gaining access to cash at rates that the average consumer can never access. In this scenario, the bank is no longer trying to extract fees from the client. It is trying to keep the client's capital within the institution's ecosystem for as long as possible.
The institutional response to wealth becomes even more distinct at the $10 million and $50 million marks. At these thresholds, the individual is often categorized as a sophisticated investor or a qualified purchaser. These are legal designations that effectively remove many of the consumer protections designed for the general public. While this sounds like a disadvantage, it actually opens the door to the shadow financial system. Institutional behavior at this level involves providing access to private equity, hedge funds, and bespoke credit structures that are not available to the public. The bank's role shifts from a safekeeper of money to a gatekeeper of opportunity. The fees at this level are not about account maintenance, they are about performance and access. The institution and the client become aligned in a way that retail banking does not allow. If the client's wealth grows, the bank's assets under management grow, and the resulting fees increase. What is particularly interesting is how risk is handled at these higher thresholds. In the retail world, risk is binary. Either an individual qualifies for a loan based on their credit score and income, or they do not. In the world of high net worth finance, risk is a negotiable variable. If an individual wants to undertake a high-risk venture, the bank may participate, but it will structure the deal so that the risk is shared or mitigated through complex derivatives and insurance products. The bank becomes a risk mitigation partner rather than a simple lender. This is also where the concept of family offices begins to emerge. When wealth reaches a certain scale, the individual creates their own mini-institution to interact with the larger banks. The family office employs its own analysts, accountants, and lawyers. This changes the power dynamic significantly. The bank is no longer dictating terms to a customer. It is competing for the business of an institutional peer. The data shows that at this level, the cost of capital drops significantly because the family office can play multiple banks against each other to secure the most favorable rates. The invisible thresholds also dictate how institutions treat failure.
In the retail sector, a missed payment or a bankruptcy is a catastrophic event for the individual, often resulting in a total loss of credit access. In the world of high net worth finance, failure is often treated as a restructuring event. Because the bank is so deeply intertwined with the client's assets, it is often in the bank's best interest to help the client navigate a crisis rather than foreclosing on them. This is the origin of the phrase too big to fail, which applies not just to banks, but to the most significant clients of those banks. The pattern that emerges across all these levels is that the financial system is designed to be a closed loop for those with high capital velocity. The more money an individual has and the faster it moves, the more the system accommodates them. The rules that govern the retail consumer, interest rates, credit scores, and collateral requirements become increasingly flexible as the individual's value to the institution grows. Understanding these mechanics reveals that the financial system is not a monolith. It is a series of layers, each with its own set of physics. What is true for a person with $10,000 in the bank is often the exact opposite of what is true for a person with $10 million. The institutions do not treat people differently because of a moral preference, but because the math of risk and reward changes as the numbers get larger.
These patterns are rarely discussed in mainstream financial news or academic settings. The reason for this silence is structural. The retail banking system relies on the stability and predictability of the general public. If every retail depositor understood and attempted to use the leverage strategies employed by the ultra-wealthy, the system would likely face a liquidity crisis. Furthermore, the specialized products and thresholds discussed here are part of a competitive advantage for banks. They do not advertise these services to the general public because they are not profitable when applied to small amounts of capital. The complexity of these arrangements requires a high level of human oversight and legal structuring, which is only justifiable when the transaction sizes are substantial. By looking at the data and observing how institutions behave at different thresholds, it becomes clear that the rules of money are not fixed. They are functions of scale. The banking system is a mirror. It reflects back the complexity and the risk profile of the person standing in front of it. As the profile changes, the reflection changes, and the invisible thresholds of the financial world begin to reveal themselves. This hidden architecture is what truly governs the flow of global wealth, operating quietly behind the storefronts of the banks we see